Welcome, welcome. All right. So we have Trump uh, headed to China. He's on the flight right now, and the meetings begin tomorrow, and they will take place all day tomorrow, as well as Friday, and then Trump will head back to the U.S. So there is a lot of um, excitement about these meetings, and the question that I keep hearing from very sophisticated, very high level geopolitical analysts is who has the leverage going into this trip, into Trump's China trip. Does Trump have the leverage or does Xi Jinping have the leverage? And my question today is, does this question even matter? And we're going to jump into that. Um, Now, before we get there to the main topic, I just want to discuss a little bit the state of the stock market. Um, I expect that the stock market, for a little period of time, not very long, but for a little bit of period of time, is going to run out of steam. And the reason why I want to address it is because it's not that I'm concerned, but if it happens, if beginning essentially now and through the summer, we have a choppier, more difficult market, I don't want anyone to be concerned about it. And if it happens, I don't want you to kind of be shocked by it. I want you to be well prepared. So why might we just sort of chop around for a while and have a difficult tape? Or even when I say tape, it means the market. Or even see some declines and perhaps even some significant declines. Well, first of all, as you all know, we've been hitting all-time high after all-time high. And the stock market is now sitting at a price to earnings ratio, a PE ratio of about 21.4. Now, that's not all that high. We've been significantly higher. At the end of 2025, we were through 22. The PE ratio was above 22, maybe 20, even 22 and a half. We've been at 22 at the end of 2024 as well. So 21.4 isn't all that high, but there's a perception out there that the market is incredibly high, and many people saying it's a bubble, it's overvalued. The reason why there is this misperception in economics, we call it price illusion. When prices go up very fast, people tend to think there's a bubble. But what a lot of people are ignoring is the denominator, the earnings, to really gauge whether a company is expensive or the stock market is expensive. You can't just look at the price. You also have to look at the denominator, which is the earnings. And the earnings have been absolutely explosive. And Wall Street analysts have had to continue to ratchet up their earnings expectations for the next 12 months and for 2027. And as a result of these very powerful earnings results that we keep getting that are blowing away Wall Street analyst expectations, that PE ratio is actually not very high. I mean, 21.4 isn't cheap. When we think about cheap, we think about 18, 17. 21.4 isn't cheap, but it is not terribly expensive. But there's a perception out there that it is expensive. And I keep hearing from my my ex-colleagues in the hedge fund world that this market is ready to decline. And I have a sense that a lot of hedge funds are getting ready to put some shorts on the market. And we get this, right? Every few months, we get the hedge funds piling in and shorting the market, and it definitely causes a bit of a downdraft, a bit of a sell-off. So I wouldn't be surprised at all, just because the price has gone up so much, that we get the hedge funds trying to push this market down by shorting the market. Um, several other reasons why I think we may be going through a difficult period. Secondly, we just have had some pretty ugly inflation numbers. Yesterday, we had a CPI number, that consumer price inflation, And that number came in a touch high, just a tenth higher than expected. But today we got producer price inflation. That is the prices that companies pay for the products that they buy. And that number came in much above expectations. And oftentimes, that is a precursor to higher CPI numbers because if companies have to pay a lot more for their goods, possibly in at least in the past, it would just be a matter of time before they pushed on those higher prices that they were paying onto the consumer. Now, it could be a little bit different this time because companies have such big earnings that they're sitting on. Productivity gains from AI and other technologies have boosted earnings to such an extent that maybe companies can absorb some of the higher prices and not push those higher prices onto the consumer. But if history is any guide, we are likely to see the consumer price inflation also to continue to edge up in the months ahead. Now, a lot of this is obviously due to the high oil prices due to the war. And once the war passes, we'll see these inflationaries recede again. But for the time being, the war is still raging, oil prices are still high, so we probably have some months of higher inflation numbers. Now, why is that a problem for the stock market? Really, the only reason why inflation could be good for the stock market sometimes, but the reason why it could be problematic is there were hopes that the Fed under Kevin Warsh would maybe later this year, but certainly early next year, the Fed would start to reduce interest rates. And obviously, lower interest rates is always good for the stock market. But if the Fed cannot cut interest rates, and in fact, if inflation persists, you might get some members of the Fed pushing to raise interest rates. And if we start to get more talk in the coming weeks that the Fed might even contemplate raising interest rates, and you could certainly get that talk, that could put some downward pressure on the stock market. So that's another reason. A third reason is there is the old conventional wisdom among Wall Streeters is that once May hits, then you have June. Everyone goes on, starts taking summer vacation. The traders on Wall Street, they're in, they're out. The trading desks are fairly thin, lightly populated, and investors sort of take a breather and they pull money out of the market or at least stop buying. So the old adage is sell in May and go away. And then investors come back, in October, even November, and start buying again. And you get this year-end strong, powerful rally. That has been a cycle historically. Now, in recent years, we really haven't seen such a cycle. The sell in May adage has not really worked out, but you still get that sentiment. And hedge funds, again, they try to pick certain points on the calendar where they give a shot to shorting the market. So May coincides with some of these other factors that I mentioned. And finally, the final and fourth reason is the war is looming. And I suspect that after Trump gets back from his China trip, he may make a decision to restart the bombing to really inflict some major pain on this Iranian regime and either attempt to topple it, even though Trump will never talk about toppling it anymore, or at least damage it significantly to bring them back to the negotiating table. So these are four reasons why we might see a more difficult market in the coming weeks and perhaps even the coming months. We might not, right? The market may shrug it all off. Trump may not decide to drop bombs, or if he does bomb, I do suspect it to be very short. It may last a couple days, or I think the longest it would last is 2 weeks because the U.S. military says we have 2 weeks of targets to hit. The Israeli military says the exact same thing. So it will be a fairly short campaign. But anyway, I think we'll get some drop once that bombing starts. But then again, if he decides not to bomb and he just continues to squeeze Iran by closing the Strait of Hormuz and just tighten the noose by squeezing their economy by not allowing any exports or imports in and out of Iran, maybe you don't get this dip that I'm talking about. But if we do, my year-end target for the S&P 500 is 8,000. Now, I had given this target at the end of 2025, and for a little while there, when the stock market had dropped by 10% at one point this year from its peak, that 8,000 target was looking like a pipe dream. It was looking like a fantasy target. But I never changed it because you never know. And now that 8,000 target is looking pretty good. And it's actually just 8% away from here. So if we end up with the S&P 500 rallying another 8% from where it is right now, that would give the S&P a return of about 16.8 percentage points. Okay. Now, our portfolio here in the inner circle is running about 4 percentage points ahead of that. So that is really phenomenal performance. So our year-end performance, assuming that it stays right there at 4%, it might increase, it might decrease a little bit. I expect it's going to increase. Our return would be something like 20.8%, or maybe even a little higher than that. Now, if the S&P 500 closes the year at 8,000, that would leave the price to earnings ratio, the PE ratio, at 21. So it would actually be lower at the end of the year than where it is right now, even though prices would have gone up by another 8%. How is that? How's that possible? Well, the reason that's possible is because forward-looking earnings, if we look at earnings going forward into 2027, the expectation is corporate earnings are going to continue to grow very powerfully and actually significantly faster than the pace that the S&P is rising. Okay. Now, I think my forecast is pretty optimistic. The most optimistic forecast I've seen out there is by an economist by the name of Ed Yardeni. Some of you may have heard of him. And he was up until a few days ago, his year-end target was at 7,700. So he was more pessimistic than I am, but he just revised it up to 8,250. So if he's right, and the S&P 500 closes the year at 8,250, and again, that's the most optimistic forecast out there, that would bring the PE ratio to 21.7 at the end of the year. So that would just be a little bit higher than where it is right now, right? The P ratio right now is 21.4. That would push it up to 21.7. Still not too bad. And that would, now let's assume that the 8% return that we've had in the S&P 500 thus far this year, so between January 1st and now, the S&P 500 is up 8%. If we just project forward and assume that the S&P 500 continues to rally at the same rate, that would result in a return for the year of the S&P 500 of 23.5%. That is really a very, very powerful return. And that would leave the S&P 500 at 8460 at the end of the year. Now, I think that's too high, right? I think that's too high, and that would give us a price to earnings ratio of 22.3. Again, that's not outrageous. It's not impossible. Again, that's where we closed the year in 2025. I mentioned it was about 22.5. So it could happen, but I think it's unlikely. And that's why I think the best thing for the market right now actually would be for it to just chop around for the next couple months or even go down a bit. And again, if that's the case, don't be worried. And I know some of you are sitting on cash. And if we do see that market come down, not sitting entirely in cash, I know some of you have a bit of a cash buildup for various reasons. If we do get this downdraft in the market over the next few weeks, that will represent your opportunity to jump in. Now, if we don't get that downdraft in the market, I'm going to suggest that you probably jump in anyway over the next 2 weeks. So, we'll deal with that individually on a one-on-one basis over our Telegram chats. But now let's move to China and really the topic at hand that I really wanted to dive into. So Trump is making a very, very big deal of this China trip. And in all likelihood, there are going to be some big announcements. Trump would never make the effort to travel all the way to China if agreements were not already hammered out. He's not going to leave anything to chance, right? History shows that when a president travels abroad, especially to like our arch enemy, China, you're going to want to show the American public that that trip was really worthwhile. And to sort of emphasize this point that Trump is looking for some big announcements out of this trip, the list of businessmen that he brought on Air Force One to this trip, it's a very impressive list. And I'm going to read some of the names to you. Elon Musk, right? The CEO of Tesla and SpaceX is on the plane. The CEO of NVIDIA, Johnson Huang, is on this trip. The CEO of Apple, Tim Cook. The CEO of BlackRock, Larry Fink. The CEO of Blackstone, Steven Schwartzman. So some of the biggest names on Wall Street. You also have Wall Street, the CEO of Citigroup, Jane Fraser, the CEO of Goldman Sachs, David Solomon. Okay, I'll just run some other names by you. The CEO of Boeing, the CEO of Cargill, the CEO of General Electric, the CEO of Micron, the CEO of Qualcomm. And Trump says these aren't the only names. These are just the names of the people that are on the Air Force One with him. But there are other big names that are meeting Trump in Beijing today. So this is, you don't bring a cast of CEOs like this unless you have some big announcements to make. So we could see, the market run up over the next 2 days, but that could be a sort of a bit of a head fake in the market. Could be a bit of a head fake. And I've seen in my long career that oftentimes hedge funds will look for a short-term peak in the market, a big event, and they will all either officially or unofficially coordinate around these types of events and then short the market right then, either right after or during the meetings. And if that coincides with some bombing against Iran, you could get a drop in the market. So these are things that are on the forefront of my mind right now. But just to sort of emphasize, and we have never in history, really never in history, seen a trip even remotely near this scale and caliber in terms of the personalities that the president is bringing to such a meeting. Okay, so you should expect some big announcements out of this, and the announcements may be bigger than most people realize. Now, does that mean just because you get some really huge, massive announcements, you get put on this enormous show, does that mean that there's going to be real, tangible results that the American public is going to feel as a consequence? Well, if you remember Trump's Middle East trip, sometime last year when he went to Qatar, and he made all these announcements of enormous investments from the oil-rich Arab world coming into the United States, right? It was all huge announcements, massive announcements. But have we really seen massive investment from these countries? Has it made a difference to our economy? Nothing that we can see. So at least not yet. So it may be an enormous amount of pomp and circumstance, big announcements, but in terms of real tangible results, that's an open question, and I'm probably skeptical because our biggest adversary or our biggest enemy is not looking to really do any great benefits or help out the United States in any significant way. Now, let's go to this question: who has the upper hand? Who has the upper hand? I believe that this question is an over asked question. And why do I think that? Because there's really nothing that China can do to pressure the United States, can pressure Trump. Really, they and there's really not a lot the United States can do to pressure China, right? These two adversaries have been going at it for a few decades now. And there have been many meetings between the American presidents and Chinese presidents. And there's been meetings between Trump and Xi Jinping before, not in this administration, but in the prior administration. And it didn't really matter if anyone had the upper hand or didn't have the upper hand. There were no real winners or losers coming out of these types of meetings. And I don't think this meeting is going to turn out to be any different. So if one side has a little bit of leverage over the other, I don't think it matters. I really don't think it matters. But there's a better question to ask. And the better question to ask, and it really has nothing to do with this meeting, is who has the upper hand in this multi-decade marathon for influence in the world. And here I think we can make some pretty clear and firm observations and conclusions about who has the upper hand in this marathon that both countries are running. So just a few years ago, there were predictions from economists and geopolitical analysts that China was on the verge of overtaking the US economy. And by now, according to all these projections, China should have overtaken the United States in terms of the size of their economy. And I have been knee deep in these arguments for many years, and I'm telling you, all the experts in the State Department, at Harvard, at Columbia, in the National Security Council of the United States, in the CIA, virtually everyone thought that by today, certainly, China's economy would be outstripping the United States. But where are we? The US economy is at least 1.5 times larger than the Chinese economy. Our economy is $32 trillion, and the Chinese economy is $20 trillion. Now, I say we're at least 1.5 times larger because China notoriously lies about its economic data. So in all likelihood, that GDP number that I just gave you on China, the size of China's economy of 20 trillion, it's probably exaggerated. I don't know by how much it's exaggerated, but it is certainly exaggerated. So we're probably quite a bit more than 1.5 times larger than the Chinese economy, but I can't give you a specific number about how much exact. So we're at least 1.5 times larger. Let's be conservative. Now, income per person in China, that is your average Chinese person, makes about $15,000 a year. Again, we know China exaggerates, so it's probably lower than that. but let's take them at their word. Let's say it's 15,000 a year in income that your average Chinese person makes. In the US, the average person makes $95,000 a year. So we are 6 times higher. The average income is 6 times higher in the United States than it is in China. That is a big, big, big difference. And the Chinese economy is on the decline. China experienced its fastest growth rates between 2000, the year 2000, and 2011. And ever since then, the economic growth rate has been decelerating very rapidly. Why is that? Why has the Chinese economy been decelerating? Because ours hasn't been decelerating, right? If anything, the US economy has been accelerating. And the reason why the Chinese economy is on the decline is because it has an authoritarian political and economic model. You could even say it's totalitarian. Authoritarian is sort of partial control by the leader. Totalitarian is complete control. So it's somewhere in between authoritarian and totalitarian, which means the decision making in China is highly centralized. It's highly concentrated. And at the end of the day, it's really one person, Xi Jinping, who's making the decisions for the entire economy, for every single company in the country. Now, a lot of people think that this is an advantage. Why? Because it allows the government to pour all of the resources of the country into very specific industries or very specific companies. And that enables the country, China, to make very rapid advances in these industries. So, for example, you'll hear people laud the incredible advancements of China's electric car industry, right? And there's other industries as well. But you hear a lot about their electric cars and they're better than Tesla, they're better than all of our electric cars. Probably true. But when you have such concentrated power and you throw the resources, all the country's resources, into a few different sectors or a few different companies, guess what it also leads to? It leads to terrible mistakes because one individual or a group of individuals are not all knowing, right? They make mistakes, they're human beings. It also leads to massive corruption, right? Because you're picking which industries to succeed, right? There's a lot of payoffs involved in that, right? Companies will there's a lot of bribery involved, right? Paying off officials for influence. And it also leads to highly inefficient allocation of resources, right? So rather than allowing businessmen all over the country making decisions that are best for their companies, it's one man, or best case scenario, a couple of men making the decisions on how to allocate capital to the entire country. That cannot be efficient, right? It's highly inefficient. And as I said, highly corrupt. Now, I mentioned that you end up with a few blockbuster industries, but it also leads to a very low standard of living, right? Because when you're pooling all the resources into a few sectors, you're depriving the economy at large of all these resources. And as a result, it leads to this very low standard of living, which we mentioned earlier, people making on average $15,000 a year. And when you have a very low standard of living with very low incomes, it means that consumption in the country is very depressed. And this is a huge problem in the Chinese economy. Low incomes, because you have inefficient allocation of resources, with very weak consumption. So, how does China grow? How do they grow at all? If the Chinese people aren't buying the products, you have to export it. You have to sell all your product abroad. And that's why in China, their only growth driver is their export sector because the household is so fragile, it's so weak. Now, when you have a fragile domestic economy, how does the banking system make money? You have a weak domestic economy, not many thriving businesses. You have a few thriving businesses, right? That the government chooses, pushes all the resources, but you have a big banking system. Who is the banking system going to lend to? There's only a few companies that are dominant there. Who else are the banks going to lend to? Well, banks are desperate to lend. And who did they lend to? They lent to the property sector. And all these bank loans went into the property sector and they built up these massive, massive buildings, this huge, beautiful infrastructure. But guess what? You have a very weak household sector. Who's buying all these buildings? Nobody. So many of these buildings that are beautiful. You have tourists, so many American tourists I know, they go to they go to China, they travel to China, they say how beautiful, how amazing. But guess what? You're staring at empty buildings. So banks made loans to construction companies to build this enormous infrastructure that is sitting empty, producing no income, and now you have a banking system that is essentially insolvent, and the government is propping it up. Now, again, we hear these stories about their electric cars. We hear stories about their AI company, DeepSeek, right? Remember the DeepSeek scare of early last year? DeepSeek is going to eat the lunch of all the US AI companies, right? It didn't pan out. Does anyone talk about DeepSeek anymore? I'm sure we'll hear about it again in the future. But they have a very thin entrepreneurial class because the government dominates and the government decides what companies to fund. And as a consequence, it doesn't pay very well to be an adventurous businessman in China, right? They have a very thin, ineffective entrepreneurial class in China, right? Who are their great inventors? Where are their great CIOs? We worry about Chinese AI, right? And the great competition. And we should, right? We need to beat China in AI. But where are all the great AI companies in China, right? The US dominates. Our companies are by far the world class AI industries. It's not even comparable. Now, that doesn't mean we should be complacent, right? China is our greatest competitor and they're dangerous, right? They are dangerous just like Russia is dangerous. Russia is a failing economy, but they're dangerous. Iran is a failing economy, but they're dangerous. Just because an economy is failing doesn't mean that our adversaries and our enemies are not dangerous. They are, but they are not a serious economic competitor. What about the Chinese military? We hear a lot about the threat that China presents, and they are a threat. But and we hear a lot about the Chinese Navy, and we hear about our shipbuilding is weak and no match for China. But here's the truth, and this is what you never hear, but it's something that I've learned is that the United States has what's called a blue water navy, which means our navy is capable of projecting power absolutely anywhere in the world. There's no other navy that could have sailed to the Persian Gulf to do what we're doing in Iran. China couldn't do it. Russia couldn't do it. Nobody could do it. Only the US Navy. Now, China has what's called a brown water navy, which means they can only send their ships to their backyard. Yeah, they could reach Japan, they could reach China, but they can't really project power outside of Asia. We have by far the most powerful navy in the world. Now, it does not mean that we can be complacent. We need to build up. And if we withdraw from the world and we don't spend on our military, China is far bolder than we are. We know that Iran is far bolder than we are. Russia is far bolder than we are. They don't care about their citizens. They are perfectly willing to wreak havoc in the world to take advantage of U.S. complacency and U.S. reluctance to get involved in the world. They're perfectly thrilled when they sense reluctance on our behalf. So we need to continue to build. But make no mistake, we are the dominant military in the world. We are the dominant Navy in the world. We just need to continue to maintain and actually build that advantage. Um, so let's get in a bit more to China's weaknesses because I presented this as a marathon, right? This is a marathon that the US and China are waging against one another, engaged in against one another, and we have the edge. Let's dig in deeper on China's weaknesses. China's demographic problem is one of the biggest long term structural challenges facing any country in the global economy. And China faces a combination of demographic challenges. Number one, they have a rapidly shrinking working age population. Okay. They have very low birth rates. Uh, you know this, I'm sure. Every household in China averages one child per family. As a consequence of just one child per family, they have a very fast aging society. They are an elderly country. They also have a huge gender imbalance. There's far more men than women, which is a huge problem for for fertility rates, for childbirth, right? You should roughly be, more or less balanced between men and women in China. But in China, there's far, far more men than women. Why is that? Why is that? Because during the one child, there used to be an official one child policy in China. And most families, many families wanted a boy because a boy would turn into a strong young man, and a strong young man could help with, farming and so on. So a lot of times, what Chinese families would do if they had a daughter, they would eliminate the daughter and continue to eliminate their girls until they had a boy. And as a consequence, you have this huge gender imbalance in China. And number five, you have a huge problem of youth unemployment, right? We mentioned that the domestic economy is quite weak, so young people have a very, very difficult time finding jobs. And if you have an elderly population and a very elderly population, and you have very few young people, and those young people can't find jobs, as the elderly retire, you have an economic time bomb on your hands because who's going to support the elderly if you don't have young employed people to support them? So this is a bit of an economic and demographic time bomb. And together, these five factors, you combine them, and it creates an inevitable situation where you have slow economic growth. When you have slow economic growth, it's hard to collect taxes, right? Not a lot of tax collection going on. So fiscal deficits grow. You get bigger and bigger government debt. And this has important geopolitical consequences because how do you continue to fund a military to confront the United States? So these are big problems that China has that people really do not grasp. And I think we exaggerate the challenges that China presents to us in the future. Again, I'm not arguing for complacency. I think we should put our pedal, put our foot to the gas pedal, and increase the pressure on China, like we did against Russia, the way Reagan did against Russia. He recognized that they had a problem, and he just expanded our military spending and buried them because he knew they couldn't keep up. Now, um, I just want to discuss a lot of these ideas in even more depth. So, I mentioned China is moving toward a society where there's a huge percentage of the population being elderly. This means that there needs to be more healthcare spending. But you can't have more healthcare spending because you have fewer and fewer workers paying taxes for the reasons I mentioned before. Another problem is when you have a shrinking population, and and you have the government concentrating its resources in a few sectors, most of the economy is not very productive at all. And that's why you have these very low wages. So in the United States, we have this explosion in productivity because of AI. In China, you actually have the exact opposite. So the headlines of the electric cars, and you can pick the industry, that's what's in the newspaper. But the reality is, for the economy at large, we have slowing productivity, and as I mentioned, slowing consumption. So what's happening here is you're getting a fewer and fewer workers supporting more and more retirees. And this is really the recipe for major economic problems. And I don't know that we're going to see, like, just a crisis erupt, right? It just may be sort of a slow burn, a slow erosion of the Chinese economy. But it's happening. It's happening before our very eyes. It's not getting a lot of attention, but this is absolutely unfolding. Now, China's growth model, the reason why you had super strong growth between 2000 and 2011 is you had an abundance of very cheap labor, right? All this cheap labor was in rural areas. They were doing farming. And China began to rip off a lot of our technology, rip off the technology from the United States. And they brought all this cheap labor from the rural parts of China. They packed these people into the cities, and they had this population fake population explosion, people moving from farms into the cities. They took all this new technology that they stole from the United States, and you had this boom in manufacturing. Boom in manufacturing. They exported all that product to the world, mostly the United States. I mentioned the banks lending to a lot of construction companies. So you had this boom in construction. So you had this explosion in economic growth, which caught the world's attention. And everyone was so incredibly impressed by this little over a decade of rapid Chinese growth. And they thought this was going to last forever. And they missed this crisis that was unfolding. And now you're getting more people picking it up and seeing it, but not enough, right? Not enough people understand what we're talking about here. And we are starting to see now this demographic tailwind that they had reversing, right? You had all these people crowd into the cities, their manufacturing explosion, but that took place. That's behind us already. They can't take any more people and throw them into the cities and combine it with new technologies, right? That expansive phase has run its course, and now we're in the rapid deceleration phase in China. And this aging population problem, the demographic problem is really kicking in, and it's going to get a lot worse. Now, what's China's strategy to offset this? Because they're not stupid. They understand the big problem that they face. And the way they're trying to confront it is through AI and robotics. And their goal is to replace human beings with robots and AI, right? And to maintain or regain fast economic growth, even though they have this dramatically shrinking population, but they're going to lose millions of people over the next few decades because of this demographic time bomb that we've explained. But they're trying to offset it by replacing human beings with machines. And the question is, can they do it? Now, they do not have a creative society, right? They do not have a creative society. When you have a government that is authoritarian or totalitarian, people do not have the freedom to investigate, to research, to learn. The government controls anything. So it is the opposite of a creative society, and they rely on theft from the United States. So if we're smart, we're going to really seal, basically block off their ability to continue to steal from us. That's been a challenge that the United States has faced in recent decades, and it's going to be a challenge that we continue to face. And the more effective we are at preventing them from stealing, the faster we will contribute to their demise. And their demise is really they've laid the seeds for that themselves. So, the bottom line here is that um, China is a shrinking and aging population. This ultimately will translate into reduced military manpower, right? As long as we don't allow them to steal all our technology, the resources, their ability to fund a growing military should be fairly limited, and this gives us a huge advantage in this marathon that we're facing. Now, again, it doesn't give Trump any real leverage going into these meetings, but it gives the United States enormous leverage that for years to come if we play our cards right. And that doesn't mean we shouldn't be afraid that China won't invade Taiwan. It might invade Taiwan, and many people correctly argue that China may make their move sooner rather than later because they understand that the clock is ticking against them. And the longer they wait, the weaker their military will become. And if they don't act soon, they're going to miss their moment. So that is an argument for the United States to ramp up our military might as fast as possible to prevent them from acting sooner rather than later. So, that concludes today's talk. Let's see if there's any comments or questions on this or anything else. I'm happy to take questions on the economy, on Iran, or anything else.